If there's one thing that almost nobody turns down, it's a pay raise. And when it comes to investing for retirement, that's exactly how we think about the companies that are inside your investment portfolios. At Guardian Partners Wealth Management, you know that we focus heavily on businesses that not only pay dividends, but grow those dividends over time. Why? Because dividends matter. But growing dividends, that's the real signal. Think about your investment portfolio the same way you would think about owning your own small business. If you owned a business and every year the earnings of that business continue to rise year after year through good economies, bad economies, uncertainty, what would you conclude? Maybe you'd say something like, this is a well-managed business. This company is very well organized. And this management team has handled turbulence before, it seems. And that's exactly why dividend growth can act as a guiding light, almost like a north compass for investors, because dividends don't just magically appear out of nowhere. They come from earnings, from profits, from cash flow. Dividends are paid or they are not paid. So while the world obsesses over account values and market headlines every single day, we believe many investors overlook what silently drives those outcomes underneath the surface. Earnings growth, your dividends. We've said this before, but it is worth repeating. If your investments are giving you the evidence that the earnings of the underlying businesses are growing, and those companies continue increasing their dividends, then what eventually has to happen over time as well? The overall value of those investments must generally follow the direction of earnings. Now, we don't always know when the market decides to recognize that value. Markets can be emotional in the short term and they can wildly swing. But over long periods of time, positive business results tend to show up eventually. Now, that's why we spend less time trying to predict headlines and what's around the corner and more time focusing on the quality of the businesses themselves. Are the earnings growing? Are the dividends growing? Is management behaving in a disciplined manner right now? Has the company proven it has been able to navigate difficult periods of time? Now look, dividends are never guaranteed. Nothing in investing comes with certainty, and many investment strategies are ultimately built around theories and probabilities. And we understand that. That's why the research matters. That's why the structure matters. That's why discipline and proper management matter. The goal here is not perfection. The goal is identifying strong businesses with durable earnings, healthy cash flow, and management teams that have shown the ability to navigate difficult periods over time. Because companies that consistently grow their dividends are often showing you something deeper than the surface: operational strength, financial discipline, and the ability to adapt over time. At the end of the day, growing dividends are more than just retirement income for you to spend. They are evidence of business growth, evidence of profitability, and evidence of resilience. And frankly, I don't think I've ever turned down a pay raise. How about you? So when thinking about your retirement investments, maybe the better question isn't simply, what's my account worth today, Wes? Maybe the better question at hand here is, are the earnings of the businesses I continue to own, are they continuing to grow their earnings? That is where real investment success often begins. Thanks for watching this video today, and feel free to send it along to somebody who you think might benefit from it as well.